Center of page 46. Non-forfeiture options, guaranteed values. Probably a couple test questions on these. And the non-forfeiture options are required by law. And they apply to cash value policies. So whole life, endowment. Whole life policies, endowment policies, they all have non-forfeiture values or non-forfeiture options. So we'll use an example here. We'll say that I have a whole life policy, $100,000 face amount, $40,000 cash value, and the policy lapses. Okay, policy lapses. What happened? What did I not do? Pay my premium. I had a grace period, remember? Grace period of time to get my premium in. How long was my grace period here? 30 days. So I didn't pay my premium during the grace period. Policy lapse, which means currently I have no coverage. Now, by law, the insurance company has to give me the option of what I want to do with that money. What I want them to do with my cash value. Remember, that's my money. I didn't die. I haven't paid my premium, the policy lapsed. So I have the right to choose what I want to do with that money. That's what these non-forfeiture options are. There's 3 of them. And you can remember them with the acronym CER, SIR. So they send me a letter and they say, "Sir, your policy's lapsed. What would you like us to do with your cash value?" Your first option is to take cash surrender. If I do this, I have no more protection. No more insurance protection. Okay? They send me a check, and then at that point I have to determine if I need to pay tax. Remember, if that cash value is more than I paid in, I'm going to have to pay ordinary income tax on the difference. Now here's where it gets a little different. We have number 2, which is extended term. And extended term, here's what they do. They take my cash value and they buy me a term policy. And that term policy will extend the face amount for a certain period of time. So with extended term, I would have the same face amount, $100,000, that I had in the previous policy. That's what they're extending, the same face amount, same amount of coverage, amount of protection. But it's temporary, because it's term, and there's no cash value. So they say, okay, well, how long will $40,000 provide Scott $100,000 of term coverage at his current age? Well, not based on health or anything, just on my current age. They say, 6 years, 3 months, 4 days. That's how long. Exactly. Okay? So they'll determine that. It's going to depend on the situation how long the length of coverage is. And by the way, extended term is the automatic option. If they don't hear from me in 60 days, they'll automatically take that cash value and put my policy, purchase me a term policy, extended term, non-forfeiture option. Last choice I have is called reduced, paid up. Now what's reduced here is the face amount. This is whole life. Further from that, it's single premium. Single premium whole life. Now you could imagine though that the amount of coverage would be reduced. Why? Because they're only using this one premium, $40,000. Okay, so I pay my $40,000. They use it, that cash value, as a single premium. No more premiums due. It's paid up. Reduced face amount, whole life, permanent, till I die or age 100. Cash value, right? So we'll say that the amount of coverage goes down to $75,000. But it's whole life. Covers me till I die, age 100. I could take a loan out. I could cancel that one as well if I wanted to. So 2 questions for the exam here. Which one of these non-forfeiture options provides the highest amount of coverage? And by amount, I mean dollar amount. Which one provides the highest dollar amount of coverage? The answer would be this baby right here. Why? Face amount is the same as it was in the old policy. So the highest amount, I'm talking dollar amount. Well, what if the test was to ask you which one provides the longest length of protection? Right here, reduced paid up. Why? Whole life, permanent. What was reduced? The amount of coverage. But it's permanent. Longest length of protection. Okay, I know these non-forfeiture options are very difficult, but you've got to know them for your exam. They give a pretty good example there in the book on them. Last paragraph on page 47, you want to highlight that. Okay, that basically answers those two questions I just asked you, and we go ahead to page 48, top of the page, policy loans and withdraw options. Okay, now we just talked about cash surrender. Okay, you can take cash surrender on any cash value policy. And before we go on again, I want to reiterate with this. If they asked you a question on the exam and said, which of the following policies does not have non-forfeiture provisions or non-forfeiture options? The answer is going to be any term policy. Remember, the non-forfeiture options only apply to cash value policies, not term. Okay, so going ahead, we talked about cash loans. We talked about cash surrender. Either one, cash surrender or a loan, the insurance company has up to 6 months to defer the request, so they have up to 6 months to get you the money. As a general business practice, they generally don't do that, but just so they don't have a run on the bank, it gives them the time to get you the money. Loans, we said, you can take them against a cash value policy. Keep in mind, though, most policies won't have a cash value till after the first 3 years. After that point, though, you can take a loan out against your cash value. They will limit the amount you can take as a loan as a percentage of your cash value. So they might allow you to take up to 75% of your cash value out as a loan. Remember, you're going to have to pay interest on the loan. If you die with a loan outstanding, the insurance company will subtract that loan and the interest from the death benefit they pay out. Okay, automatic premium loan towards the bottom of the page. Third paragraph from the bottom on page 48. Automatic premium loan, this actually is a rider to the policy. It's just a box you check off on the application. And what this does, as you would imagine by the name of the rider, you can only add it to a policy that has cash value because it creates a premium loan. It creates a loan. You can only take a loan out against policy that has a cash value. So you forget to pay your premium. Go through the end of your grace period. If you have automatic premium loan, it will kick in, keep your policy in force for you, therefore it won't lapse. Creates a loan against your cash value to pay the premium for you. Automatic premium loan. Okay, although it is creating a loan, so at some point you will have to repay it. Now, second to last paragraph from the bottom says, automatic premium loan is an option that must be selected by the policy owner. Just a box you check off on the app. You don't have to pay any extra premium for it generally. Term, this rider cannot be attached to term since there's no cash value, as we said. And we said withdrawals, we talked about that earlier, cash surrenders. Top of page 49 says partial surrenders. Okay, with partial surrenders, there's something new that we need to talk about, and they're called surrender penalties. Surrender penalties are levied by the insurance company on certain products. And they are highest in the early years of the policy and apply on a declining basis, usually until the end of the 7th full year of the contract. So what this means is if you want to cancel your policy and get your money back, the insurance company usually will charge you a penalty. Similar to if you have a CD at the bank and you want to get the money out of there before a certain point in time, you have to pay a penalty. It's a surrender penalty. You have the same thing in your life insurance contracts. So the first year it might be 7%, second year 6%, third year 5%, and so on and so forth until it's 0. And once it's 0, that means when you cancel your policy, whatever your cash value account balance is, you'll get that. So if there is a surrender penalty that applies, they will deduct that from your cash value before sending you that dollar amount in your cash value. Okay, now we have dividend options in the heading in the top of page 49. Okay, little review for us. What type of insurance companies pay dividends to policyholders? Stock or mutual? Which one of the two you think? The answer would be mutual. Mutual insurers issue participating policies. If I buy a participating policy from a mutual insurer, right on the application, it's checked off, it's a participating policy, and I also select the dividend option, which is how I want to receive my dividend. Okay, so this is what we're talking about here. I have a policy from a mutual insurer. They declare a dividend. How do I want to take it? Now, assuming I take it in cash, is it taxable to me? Answer, no. Remember, it's considered to be an overpayment of premium by the IRS. Pay my premium with after-tax dollars. Okay, so here are, and also remember, dividends cannot be guaranteed. So here are the dividend options, bottom of 49. We've got cash, not taxable. Reduction of premium payments. Just apply it to our premium that's due. Accumulation of interest, tell the insurance company to hold the dividend and pay me interest. In that situation, I would have to pay tax because the interest they pay me is taxable as ordinary income. Remember, no capital gains tax on this exam. It's always going to be ordinary income. 1 year term option. I tell them to hold on to the dividend, buy me a 1-year term policy. This could significantly increase my coverage for the 1-year period. And then we have paid up additions. Last paragraph on the page. This is a really important one. We talked about economatic whole life earlier in the life sections. This was the dividend option we could use in the economatic whole life to kind of bridge that gap between the coverage amount we had in our whole life policy and the decreasing term policy. So we would elect to purchase paid up additions, which is small, teeny whole life policies that will accumulate cash value, and the coverage amount over a period of time will accumulate as well. So we have that onto the next page on page 50. And at any time, if our paid up additions or the dividends that are left to accumulated interest equal the amount paid to pay up the policy, we can exercise the paid up option, which you see at the top of page 50, and pay up our underlying policy, meaning no further premiums would be due in that policy. Then we have a chart there at the top of the page reviewing those dividend options with you, so you've got to know those for sure. We have disability riders in the center of page 50. We've got waiver of premium rider, first one. Now disability is another word for health insurance. So these are health insurance policies we can add on to our life insurance policies. Pay an extra premium for them, provide an additional benefit to the insured. So the first one, waiver of premium rider, probably have a test question on your policy or on your test about it. Add it to the policy if you're worried about becoming disabled and not being able to pay your premium for your life insurance. So if you add this rider and you become disabled, there's a 6-month waiting period where you have to pay the premium. At the end of that 6 months, it's retroactive, and they waive your premiums due in the future as long as you remain disabled. So keep in mind, if you didn't have this rider and you became disabled, you can't work anymore, you're disabled, you no longer have income. Well, you still have to pay your premium though for your life insurance. So I mean, I know it's a different risk, but it's really very important. So we have disability income as the next heading there. Disability income is a policy where you become disabled, replaces your lost wages. You can add that as and use the money to pay your expenses. You can add that as a rider to your life insurance. At this point, we won't get in too deep to it. Health insurance, we spent a lot of time on that, so we'll get to it there. Pay or life disability benefit is really a version of waiver of premium, the one we just talked about, 2 paragraphs above there. But you would add waiver of premium rider to a policy you own on your own life. Pay or life disability you would add to a policy you own on someone else's life, because it also covers if the policy owner dies. So remember my example earlier at the beginning of this section where dad buys life insurance on son. If he adds pay or benefit life disability rider, if dad dies, death benefit does not get paid out. Remember, because son's insured. So somebody has to continue paying the premium for the son's policy. Well, if dad added the pay or life disability benefit rider, dad dies, premium gets waived for the son until he reaches a certain age. Then becomes responsible for paying it himself. Bottom of page 50, accelerated living benefit provision rider. Possibly a question on this for your exam. We talked about viatical settlements earlier on in the life's basics section. Viatical settlement is if you're terminally ill, you can sell your policy to an investor. Well, if you do that, your beneficiary loses out completely because you get the cash up front, the investor now makes themselves the beneficiary and they get all the death benefit when you die. So the insurance companies created what's called accelerated benefits and added it as a provision to some policies, but it's an optional endorsement or rider that is offered by some companies. But essentially it applies in the same situation. I am terminally ill, so they expect me to die within 12 months. I can apply to receive a portion of the death benefit prior to my death. So that, for the test, you just need to know the concept of it. If I'm terminally ill, I can apply to receive a portion of the death benefit prior to my death. It's called accelerated benefits. Okay, so not taxable, and then my beneficiary, when I die, they just get whatever's left over there. The difference between the two. On page 51, we have in the center of the page on 51, riders covering additional insureds. Okay, we have a couple different types of policies here. These are like hybrid policies that cover more than one person in some situations. So you might have a couple questions on these on your exam. They mainly have to do with your understanding of the coverage within the policy and who's covered. Okay, so pretty briefly here, we'll take a look at the differences between the family policy, which we'll look at first, Okay, so here's the family policy. We have, let's see, we'll just list husband and wife, okay? We have the husband, wife, and we'll put the kids down here. And we'll say that the husband is the primary breadwinner, and this is the person who brings in a majority of the income in the household. In the family policy, the primary breadwinner receives whole life insurance. Kids and the other spouse receive level convertible term. So the family policy really does cover the entire family. Husband, whole life, or whoever the primary breadwinner is, they receive whole life. Other spouse, level convertible term, plus the kids. All the kids are covered. So we'll say that the husband has $500,000 of coverage. Wife might have built in $250,000 a term. Kids might have $10,000 per kid. Once the kids reach a certain age, they can convert to whole life. Same thing with the spouse. But it covers everybody. Okay? That is the family policy. Now here's the big difference. We get to the next one. Family maintenance. Okay, here's how it changes. Spouse and kids, no coverage. Primary breadwinner with family maintenance, combination of whole life and level term. Right, so family maintenance is a combination of whole life and level term on the primary breadwinner. Nobody else in the family has any life insurance coverage. And then we get to the last one on the page, the last two paragraphs, family income. Similar, here's where it's different. Combination of whole life and decreasing term on the primary breadwinner. So the only one that covers the whole family is the family policy. Family maintenance is a combination of whole life and level term on the primary breadwinner. Family income is a combination of whole life and decreasing term on the primary breadwinner. All right, so we go ahead to the next page on page 52. And last part of the section here, riders affecting the death benefit amount. So again, these are things we add to the policy, making it better. Charge an extra premium for these generally. Now, none of the extra premium we get charged for this is deposited into the cash value, okay, for these riders. It all pays purely for the benefit of the rider. And most of these riders will drop off the policy at a certain age due to the high risk. So we have the first one's called accidental death and dismemberment. This is a limited policy. What I mean is it only covers two things: accidental death and dismemberment. Well, this policy is a version of accidental death and dismemberment, so it covers accidental death, but you can add it to your life insurance. So if you're worried about dying in an accident, this rider would pay 2 times double indemnity or 3 times triple indemnity, the face amount of the policy, if I die in an accident. So let's give an example. Say that I have a $1 million policy. You're the beneficiary. You are the beneficiary. $1 million. And I have a triple indemnity, accidental death benefit rider, by the way, as well. We are training for a marathon together. You're helping me train. Obviously need to get in shape here. So you're helping me train for this upcoming marathon. Big storm kicks up. Lightning hits a tree. Tree branch falls right next to us. I have a heart attack and die. I have a heart attack and die. How much money are you getting? Remember, I had $1 million face amount, my policy, triple indemnity. You're the beneficiary. Are you getting 0? Are you getting $1 million? Or are you getting $3 million? What do you think? Well, the answer would be you're going to get $1 million. How did I die? I had a heart attack. It might feel like an accident, but it's a natural cause, right? So how would you get the $3 million? If the tree branch fell on me, right? So you drag the tree branch over right on top. Oh, it fell right on top of him. Well, probably don't want to do that, but if the tree branch fell on top of me and that's what killed me, you're getting $3 million versus the $1 million. Okay, that's the accidental death benefit rider. Okay, so we have that. And we go to the next one, guaranteed insurability rider. This is a rider added to a younger person's policy. This will ensure that they are able to purchase additional life insurance policies at certain intervals with without regard to health. So if I want to make sure, I know for certain that I want to buy more life insurance in the future, but I'm worried about the fact that I could get sick, I could get cancer and be unable to because of my health, or maybe it'd just be too expensive. I can add this as a rider. And this will allow me a certain number of option dates, usually tied to my birthday, where I can purchase additional policies, regardless of my health. Now, they won't let me go any higher in face amount than I have in my original policy. And the premium is going to be based on my attained age, but it's regardless of my health. That's the major benefit of the guaranteed insurance. I'm guaranteed I can get it. Guaranteed insurable. Cost of living, the next one there, this is an inflation rider. Okay, so I'm worried about my benefits in my policy. I die, $100,000 is worth $100,000 today. Well, 30 years from now, what's $100,000 going to be worth? What $10,000 is today? I mean, you never know, but that's inflation, right? So if I want my benefits tied to the rate of inflation, I would have to add an inflation rider to the policy. So I could do that. Next one, return of premium, and the next two, return of cash value and return of premium. Very similar in function. Remember back when we talked about the traditional whole life continuous premium? Paid the same premium every year, never went up. Well, when I died, what happened to the cash value? Insurance company kept it. Well, I don't like that. Okay, when I die, I want my beneficiary to get the death benefit plus return of the cash value or return of the premiums that I pay in. I can add these riders. Now what these riders are increasing term. If I buy one of these riders, I'm buying more life insurance, is what I'm doing. And the extra premium they charge me for this pays for the term insurance. So this is only on the policy for a certain period of time, but will pay out a return of premiums, pay out a return of cash value in the form of an additional life insurance death benefit. Okay? Just the opposite of decreasing term, it's increasing term, amount of coverage goes up. The cost of the coverage, though, stays the same throughout the life of the term. All right, last paragraph on the page says, remember, riders modify the policy, generally making it better. You have to select this initially when you purchase the policy through the application. Pay an extra premium for it. None of the additional premium is applied towards your cash value. It just pays for the benefit of the rider. At a certain age, the rider is going to drop off the policy and will no longer apply. And that will be the end of that section there. So next section is annuities. Make sure you read that again before we go in to do that. And I will see you when we get there.